Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's program, we've got Jun Bei Liu back from New York in Sydney, flying to Melbourne, captured her at the airport, and she's looking at the stocks that she likes right now. She's pretty positive, which is not a surprise for Jun Bei Liu, but I think she gives some context why she is positive. And I think that's an important part of this interview, apart from the fact she does nominate some interesting companies. Then Paul Rickard and I look at Woolworths and Coles. Paul's done a story on that. Yeah, and Woolworths has really copped it. I always like a quality company where the market really smashes it. It tends to be a good time to buy. Let's just see if Paul thinks that is the case when it comes to Woolworths. Coles has done very, very well and is not showing any signs why its share price should fall. And then we have Eliza Owen from Totality. That's the old CoreLogic. And she's looking at the speed of house price rises in the Australian market and whether it's likely to keep going. And we put the spotlight on Victoria, where the price rises have been the slowest in a state that has copped a lot of problems from government taxing property more heavily than in the past. We've also got crime rate issues, lots of things bringing Victoria undone. But is it a good thing for buyers or sellers? We'll see with Eliza Owen. So let's kick off now with Jun Bei Liu of TeamCap. Jun Bei Liu, thanks for joining us at Sydney Airport on your way to Melbourne Airport.
I'm very excited to be talking about the markets anytime.
Yeah, I know what you're like. So what's your feeling about where we are with the overall market? Can we keep on rising into 2026?
I'll tell you what, Australian market, it looks good. We are now about to head into the most bullish month of the year. We are going into that center valley. And if you look at all the data, things are actually looking all okay. Now, of course, next week, there's a big thing, which is the rate cuts. If we get a rate cut, we will have a rocket. But if we don't, we know it's coming. So look, I think most of net market looks pretty good. Australian market hasn't risen as much as the US market. Our valuation is less stretched. So, a lot of the people talk about valuation and things. I think the earnings will catch up. It looks pretty good.
Yeah, and so if we so obviously the CPI out later this week is going to be very important for the rate cut possibility on Cup Day. If we do get a rate cut on Cup Day, do you think that will be good for a lot of the companies that you hold in your fund?
Oh, absolutely. Look, I think it's just a matter of time. If they do cut this Cup Day, you will see the share price rallying quite aggressively. However, if you don't, this will be your buying opportunity, because our feeling is that consumers not doing too badly. Their confidence is a little bit soggy because rate cut hasn't come through, but we know it will come through early next year. And also, we are just about to head into the Cyber Weekend. Remember, this is a big calendar event. So for consumer stock, we're expecting big things this year. So, I think that's going to be very strong.
Okay, so what companies now do you like, say compared to a few months ago, that really look interesting?
Well, I think, to be honest, a lot of the cyclical stock look increasingly more interesting. Your retailers all have come off somewhat, and it's looking more interesting, if they have any pullback. But there's a couple of names here. I do think they have way too much of a pullback with no information that's really causing that. One is some of the growth names, for example. One is Life 360. We think share prices pulled back enormously for not apparent reason. Now, we know the market at the moment, there's a lot of transition portfolio, which means there's a big portfolio being moved around for technical reasons, and these will recover. So because 360 got caught in that sort of transition, we know it just launched the pet product, and it's launched really well. So we think there's an upgrade coming. That company looks really interesting, and another one looks interesting. I don't think I'll ever say this, but I think BlueScope actually looks pretty interesting. Pull back a big way. It's almost at NTA. This is usually when you buy this company, and we're seeing the steel spread moving up. Its competitors raising prices. It's all very good signs for things to come.
Yeah. Now, a company you used to talk about before, and I've noticed the analysts really like it. It's in the retailer class. Do you still like Adairs?
I actually think we did take some profit post result. I think this is your time to actually buy into it. I think people got a bit too nervous about, oh, what's happening? Remember 3 months ago, this is exactly what happened. And then they had a good trading update and it was so strong, it popped 20%. So this is a bit of trading stop, but with the interest rate going lower, it is going to be a very, very big beneficiary. Now, aside from a day is very, very trading on very cheap multiple, your next choices will be going to the furniture retailer. They are much more expensive at this stage. So with the rate cut, I do think they're well positioned.
Yeah. And what about a company like Sonic? Yeah, once again, the analysts like it. It did fantastically during COVID. But as I say, the analysts do have a pretty positive view. What's your view on Sonic?
I think it's kind of probably going nowhere. It is a quality company. It's just that this pathology company around the world is still going through challenges of, the cost going higher and the revenue is not going higher. Sort of hangover from the pandemic days where they had so much vaccination tests. So look, it's a little bit challenging, especially the CEO now gone as well. It's just a little bit harder to see the next catalyst. But for the long term, it looks fine. It's just for the short term, I think I put my money elsewhere.
Okay, one last one, which will probably lead to another last one. But what about Pro Medicus? You know, Pro Medicus has come off the boil as well, and the analysts still love it. What do you say about Pro Medicus?
Oh, I love it. I think it's like Life 360 get caught all these technicalities in the market. Market go through different flavors, sometimes growth, sometimes value, and this will come back. It's just that it's ticking every box, kicking all the goals. It's just that people go, oh, it's too expensive. Let's buy something else, maybe BlueScope. So that's just going through that phase. It will catch up, and with all the contracts being winning, I think the earnings will look very strong.
Okay, so one last question is CSL. Lots of people ask me, it seems ridiculously low. Has the market overreacted? What do you think on CSL?
I think it looks really cheap. If you take a 12-month view, it looks okay. It's just that with this update that's coming, just a little bit worried that CSL has given itself room to have another downgrade. It just has so many downgrades that it will lose a bit of confidence for investors. So I'll probably just avoid this AGM, this strategy coming through. But otherwise, on a 6-month view or 12-month view, it looks very cheap. For the growth
when is that
delivery.
update coming, Jun Bei Liu?
It's in November. It's late November. So yeah.
Okay. So maybe it's worthwhile waiting, because even if it's a good one and it pops, well then you're jumping on a rising trend rather than trying to catch a falling knife.
You rather mix the first 10%. Absolutely agree.
Yes, sir. Jun Bei Liu, enjoy your trip to Melbourne, and we'll see you in a couple of weeks' time.
Thank you for having me, Peter.
And that was Jun Bei Liu of 10Cap. Now let's go to Paul Rickard to look at a number of companies in both the consumer discretionary and consumer staples. And also, I'm going to ask him about some of the unusual companies that I look at in the Switzer report today. Thanks for joining us, Paul.
Thanks, Peter.
Look at Coles and Woolworths today, and I've been figuring this definitely Woolworths has been built up a lot. It might be a buy if you believe that we're going to have to be defensive sometimes in 2026. What have you just?
Yeah, not the way I approached it, Pete, but I agree with your thesis. Yep. I've approached on the basis that really if you like Woolworths, you don't need Coles. If you have Coles, you don't need Woolworths. And that's the way a lot of the fund managers look at them, because the businesses are just so similar that they don't always need to be in both.
Yeah, because once upon a time, Woolworths was great and Coles was hopeless.
Yes.
Because under Brad Banducci's latter period, he had problems. Woolworths went down, but he got supporting Australia was one of his issues. And Coles at the same time, a new CEO. Even though the old CEO was pretty good anyway, but got a new one, and they've killed them.
Well, I haven't got the graph there, Pete, but in the last 18 months, Coles has outperformed Woolworths by 55%. So in that period, over that period, Coles is up about 30 and Woolworths is down 20 or 25, right? So massive divergence in the last 15 months or so. So my question, and we get a lot of people asking us, is it time to buy Woolworths? They're now down to about $26.80.
Yeah.
This was a stock that was once about 40. Coles was once about sort of $15, $16. It's now 22 something, right?
Yeah.
And I sort of don't know whether Woolworths is actually yet cheap enough. So it's quite rare, because for the last decade, or almost 2 decades, Woolworths is traded at a premium to Coles, and that's because it's the market leader. And now we see that in a lot of industries. For example, REA always trades at a big premium for Domain. CommBank trades at a big premium for the other banks. And Woolworths is in the same situation. Well, now Coles is trading at a premium to Woolworths. So, and in some categories, in terms of earnings margin, Woolworths is still a bit bigger, more supermarkets, greater revenue base.
You got Dan Murphy's too.
Yeah, Coles is a little bit bigger. So it's sort of, when's Woolworths to buy? I sort of like to say it is getting close to it, but I'm not quite there yet. Interesting enough, Woolworths has its AGM this Thursday, and maybe we'll probably get a first quarter update. Normally at AGMs, they give you an idea about how they're trading. And you probably expect to see, let's hope to see some progress, because what we do know is, in the way this financial year started, in the first 8 weeks of the year, Woolworths sales grew by about 2.9%. Coles grew by something like about 4.5%. So even they're still killing him so far. Maybe that's turned around a bit. And Coles looks lower risk. It's more expensive, Pete, but you can see what they're trying to do. Whereas Woolworths is now sort of having to spend money on price campaigns. In other words, they're lowering the cost of some of their main items to entice customers back. And it still looks a bit risky. Plus, they've still got Big W, which is just going nowhere. And
despite my free ads,
well, you're the only person I've ever met who's shopped at Big W. But Big W lost about $35 million in the last 12 months.
One of the Katimbas is terrific. I go in there on the weekends occasionally, and it surprised me. I have a fantastic Breville coffee maker, which I got for about $150, which is terrific. Anyway.
So it's very close. I mean, like, I think if you're a bit risky, you could make a case, but I'm not there yet. The analysts actually see a little more price upside in Woolworths, but in terms of recommendations, the analysts are still in the Coles camp. So pretty well every analyst has got a buy still on Coles, and only one of the analysts has got a buy on Woolworths. And so they see more potential, but I just don't think they're seeing it as a higher risk play at the moment. In other words, Coles probably not going to do a lot. It's a bit market immune. The sector itself, you started talking about consumer staples, sort of bull market. No one really cares too much about it. So probably not going to, it hasn't really done much in price terms the last 6 months. So you're not going to lose any money. You're probably not going to make a lot. Woolworths, if this AGM, they come out with disappointing first quarter update, the market will sell it again, Pete. So I think it's just in the higher risk category. So I'd like to say it's a buy, but I'm not quite there.
Okay. Now, let's go to, while you're on the subject of consumer staples, let's go to consumer discretion. And I looked at a company I would never look at, because even though I do go to Big W, I think just to tease you, quite frankly, I've never been to Adairs, but every country, big country, town or city, there's often an Adairs there. And I know Jun Bei Liu is often mentioned as being a reasonable buy. I mentioned it to her today, and she still likes it. Is it, of course, they're basically going to benefit from lower interest rates, or they don't have the same competition that you might get in North Sydney or in Turin?
I don't think they have the same competition in terms of from some of the overseas brands, in terms of sure, people in the region shop online, but the delivery's not as good, and it's not quite the way it is,
With local loyalty too.
Like local loyalty. I think it's probably a bit interest rate and economy dependent. Now, we had the sector itself, consumer discretionary, had a pretty good few months, but it's gone off the boil the last month or two.
Lucid,
And I think that's partly a function of two things, Pete. One is that, the interest rate cuts, they're probably still coming, but there's a few in the market saying, maybe there won't be as many, and it's inflation is proving to be a bit stickier. Now, we'll find out that on Wednesday just how sticky inflation is. So that's probably one. The pace of interest rate cuts was reduced. And then I think secondly, Pete, it's probably just that rotation. It was probably so strong. And things like JB Hi-Fi and Harvey Norman had huge run-ups. And then basically, if you look at JB Hi-Fi, it's done nothing the last 2 or 3 months, right?
The share price has got to ridiculous.
It's been sold off, but it really hasn't continued to run. So, and Wesfarmers is in the same category. So I think the sector sort of just, again, one of these things, we see the rotation. I'm not saying we're seeing rotation out of it, but we're not seeing rotation into it. And then on the other side of things, some of the automotive companies have struggled a bit. We've seen, you know, so it's not
Cool.
Babcock, a few others. So it's not a label.
Vegas.
Not Eagers, no. So it's a bit mixed. So I think that's probably the best thing for those companies would be lower inflation number on Wednesday. If that, then that locks in the inflation number, the interest rate cut next Tuesday.
Yeah. One thing I looked at, which I never look at, I should make the point before I tell you the company I'm interested in. Jun Bei Liu said 360 is a company that's been built up lately, but we've been built up off an unbelievably high increase over the last few years, and people were probably taking profit. But she thinks 360 looks like a good value buy at the moment. The one that shocked me was that came through our Boom Doom Zoom webinar, which Switzer subscribers are able to see on Thursdays. Was a question about Light and Wonder. I've never really looked into it. Its headquarters, Las Vegas, Nevada. But this company, like 6 out of 6 analysts like it, and the big double-digit gains, about consensus rise about 60%. And I guess, you know, they're in the gaming space, and I guess a lot of it's in online nowadays, and Las Vegas is the capital of all those sorts of things. And I suspect under a Trump regime of potentially lower interest rates, people are probably going to Vegas big time, and this company's got a very favorable outlook. I will bet you've never really looked into it.
No, I haven't. It's probably also not just lower interest rates. It's probably a slightly easier regulatory environment, or at least you're not going to get the big sort of, you know, too much push out of Washington to try to tighten things up, right? So it may not be a case of easing regulation, but you won't get the new sort of, which threatens parts of our gaming industry, you know, because of the pressure here about, you know, parts of that, you know, consumer groups and others are worrying about how people are being treated. So,
all right, you looked at 2 staid and interesting companies, what we have in the portfolio. I looked at a few unusual ones. Have you come across anything new this week that is you know, at least you're inquiring in?
Well, we didn't talk about Sonic was the other one. But
Oh, Sonic, yes.
And look, I like the Sonic business. It's just that the share price looks a bit stuck.
That's right. And Jun Bei Liu couldn't get excited about it. She's a good business. She couldn't get excited, but the analysts do like it.
And why she couldn't get excited? Because just not enough. What was going to be catalyst to get the share price back up?
I think it's done very well over COVID. It's going sideways. It just needs a new story. Basically. But the analysts do like Sonic, and I looked up because we're asked about it. I knew you liked it, and there's no real big argument against it at all.
Yeah, I think what they need to be able to demonstrate, Pete, and where the market's been a bit concerned for Sonic, is the margin's been coming under a bit of pressure over time, and that'll work a way to sort of increase their margins. So governments like to regulate things like pathology. Don't want to spend any money. It's, you know, in Australia, it's all bulk billed, but then, you know, they don't increase the fee, right?
Yeah, and governments are playing hardball.
And governments are playing hardball, and why would you? Because, you know, people have to go, doctors prescribe it, one provider is basically the same as the other. And, you know, but each year it just becomes harder as their costs go up, you know, they reach critical mass, you know, it becomes harder. So the margins get squeezed a little bit. And I think that's been one of the pressures on the Sonic business.
Yeah, and also aging population, doctors are over subscribing to it, and it's hitting the government budget as well. One last one that I was remembered, and knowing that you've struggled with this one, and purely because, and I say this with the deepest respect, Paul, because you're a tightwad, you haven't, if I am too on this company, Pro Medicus. And they like it, and they see pretty good upside with it, but you have to pay about, what, 270, 280?
You have to forget about the price. Look, to my credit, Pete, I nominated as one of the 3 stocks to buy in the Liberation Day, post-Liberation Day. It got down, it came back from about 275 all the way down to 180 very briefly.
And you went big time. You smashed it.
I meant to go in big time and didn't yet set.
Right,
okay. It went all the way back up to about 310. And just for the last few months, it's drifted a little bit, drifted down. Look, it's one of those stocks to buy. The question is when, and do you just forget about the price because it's on horrific multiples, right? It's something like 150 times earnings. It's got great thing about the business, really great long-term contracts, 10 years plus for some of it.
Very sticky contract.
Very sticky. I've never quite understood who its competitors are in the US,
Yeah.
but look, it's one of those companies that's going to be a blue chip in everyone's portfolio. I sort of think that maybe if it sort of goes down to about 270-ish, it's probably time to sort of buy a little bit and just keep some money back. So if it dips further, you can get set again. I am sort of, and I think the broker's just caught up. There's no doubt that everyone thinks the business is pretty good.
Yeah. So let's agree that if we get a surprise market crash for inexplicable reasons, you and I will be rushing for Pro Medicus.
Absolutely. Every one of the first companies I look at in a market dip down.
You realise that when the market crashed, the coronavirus, every smart aleck in town, including all the young ones, wanted to buy Afterpay, and it went up like in the first hour.
Yeah,
comps that crashed. Couldn't have the demand for it. But Pro Medicus, we're first for the door, Paul. That's Paul Rickard of the Switzer Report. And now let's go to Eliza Owen of Cotality to check out what's going on with house prices in Australia. Eliza, thanks for joining us.
Thanks for having me.
Tell us about your latest revelations when it comes to house prices in this country.
Well, housing values have risen consecutively for the past 8 months to September. And we've started to see a little bit of momentum pick up in the past few months with a monthly result of 0.8% through August, September. So a lot of that is reflective of just more money in people's pockets. Real income growth is higher as inflation has come down and you've still got a relatively tight labour market, albeit loosening. And of course, interest rate reductions, which have been all important in supporting the upswing that we're in now. So I think as we get to the other side of rate cuts, that might start to take a little bit of heat out of the market just because you've still got pretty big affordability constraints, especially for those who aren't selling to buy in and are going off savings and income alone.
Yeah. What about the impact of government policy to encourage first-home buyers?
Well, this is a great question. So recently we've had the expansion of the 5% deposit scheme. I call it an expansion because it was the first home loan deposit scheme initially introduced in 2020 that this is modeled off.
Yeah.
But because we've seen income caps removed, no limits on the scheme, it's likely that this will at least create a short-term flurry of activity from buyers who had been waiting to get into the property market, who all of a sudden have their hurdle significantly lowered. So I think that will put some upward pressure on prices, particularly in areas where the price caps of the scheme go to. And in regional markets as well, if you look at the new $1.5 million threshold for Sydney, that also applies to Newcastle and the Illawarra, where a lot more housing would fall under that threshold for the scheme.
Yeah. Okay. Going around the country, I think the last time we talked and I wrote stories, it was apparent that poor old Victoria and Melbourne have been struggling a bit. Is this still the case?
Yeah, I think that's definitely still the case. If you talk about struggling as in the pace of capital growth, it definitely remains among the lowest of the capital cities. So year to date, Melbourne home values are up 3%, and that's below a 5% increase across the Australian housing market. And if you look at some of the other cities that are maybe more welcome to investment and they're in more virtuous cycles when it comes to population and jobs growth, Perth, for example, is up over 7% year to date. Brisbane is performing very strongly as well. And of course, Darwin, which is a relatively cheap market that has a lot of room to grow, is up 13% in the past year.
Okay. Now, I know you're not an aggressive political commentator, but you did kind of infer that the environment for property investors in Victoria or in Melbourne is probably not helping. Was that what you were implying?
I think it's fair to say that from 2023, when there was the announcement of additional taxes and charges for investors, including reducing the land tax threshold to just $50,000, that this dampened investor activity. And that's something, among other factors, like very subdued population growth and relatively subdued economic activity that's contributed to a slower market.
Yeah. It's like, and by the way, this is not always the case for Melbourne. 'Cause I know when we bought something in Melbourne about 8 or even maybe 10 years ago, like I think we saw a 40% rise in about 2 years. And so I'm thinking to myself, if I'm talking about stocks, I invariably like to buy great quality stocks that the market wants to bash up temporarily. And so I'm kind of thinking that eventually either the current Labor government in Victoria will change its point of view, its policies, or a new government will come along promising to do so. And I hark back to when Bob Carr was the Premier in New South Wales. You may not have been born then. And Michael Egan was the Treasurer. They put aggressive real estate taxes in, and Sydney house prices, you would have seen this on charts, went sideways for a number of years. And when they took those taxes away, guess what? House prices started going up again. So is it likely if the Victorian government starts to rethink those taxes, it probably will be good for house prices in Victoria?
Yeah, that's a very good question. So I think that the restriction of investor activity in the market, you could say it makes the market undervalued,
Yeah.
but that's only if the taxes change and the environment does become more inviting for investors once again. Yeah, I think absolutely that could help to push housing values higher. It's also a question of whether that's what people want across the state, partly because you've had the withdrawal of investors. Maybe there's less skin in the game or interest to keep that market rising. Not only that, but there's a relatively high share of first home buyers in the Victorian market. About 28% of new housing loans in the June quarter were secured for first home buyers across the state, compared to 22% nationally. So, whether the subdued price performance is a good or a bad story just really depends on what side of the fence you sit.
Yeah, exactly. So it's great for buyers, not great for sellers. And yeah, I guess the next election will tell the story who has the biggest sway, current homeowners or future homeowners. Um, what other property developments have you noticed in recent weeks that are worth noting for those people either thinking about selling or buying?
Oh, well, it seems like a pretty robust spring selling season so far in terms of the rolling 28-day change in home values, and we'll get the latest in the first working day of November. But it seems like the regions have really picked up through the month. Again, likely a function of this affordability constraint that we're seeing even in a rising market that is pushing people further afield. Some of the top performing markets at the moment are Albany in Western Australia, Toowoomba in Queensland. They're markets that are a little bit further afield, but they have a relatively cheap price point, and I think that continues to attract a lot of demand and investment. Talking on investors, another thing that we're watching is the growth in investor credit, which was unusually high over the past few months. And that's something that also has the regulators talking about their ability to implement macroprudential policy if they see growth in investment housing lending getting too fast, getting too risky, and maybe outpacing broader income growth. So that will be something that we're keeping an eye on, and that could, of course, be a headwind to capital growth as well.
Yeah, and it's interesting because APRA has at times made the lenders make it harder for investors to borrow, and also probably with the threat of what was going to be the policy on superannuation. Probably a lot of investors started thinking, well, I'm not going to grab my super over 3 mil, better start looking for property. And a lot of those people probably turned up to auctions and applied for loans and probably got it because they've got 3 million in super.
That's interesting. I mean, I don't have data visibility on that, but you'd have to imagine that a policy like that might have those sorts of unintended consequences for the property market. And I think one of the challenges for Australia is how to sustainably grow its wealth outside of the property market at times as well.
Yeah, Well, I have financial planning clients, and let me tell you, they were talking about that exactly. If I'm going to be slugged for having 3 million in super, I'll look elsewhere, and property obviously was another one. Um, One final question to you is, um, and I won't ask you whether you think there's going to be a rate cut, because that's just you guessing as an economist, and I'm guessing as well. We have to see the CPI this week before we can get stronger on our punt on a cut they cut. But if we get a cut, do you think it's going to actually add momentum to this already pretty impressive spring sale period?
Yeah, good question, and thanks for letting me off the hook with the timing rate cut. Look, I think it will. When we were coming into the spring selling season, we were a little bit worried that maybe people already pricing in rate cuts would have tempered growth, but as it is, it's continued to accelerate. And I think the rule still stands that the lower interest rates move, the more money that tends to see directed towards the property market.
Okay. Eliza, thanks for joining us. If people want to read your brilliant stuff, where do they go?
Oh, thanks. That would be cotality.com/au/insights. That's where we post all our reports and articles.
Yeah.
So definitely encourage people to go and have a look.
Fantastic. Thanks for joining us.
Thank you. Take care.
And that was Eliza Owen of CoTality. That's the show for this week. Thanks for joining us. Now, remember, you can get daily access to what I'm thinking and my experts are thinking by going to Switzer Daily or switzer.com.au. And if you want more extensive information about what to invest in and why you want to invest in a company, have a look at the Switzer Report. That's at switzerreport.com.au. Thanks for joining us. I'll see you next week.